Factor investing is an investment strategy that uses factors to choose stocks. You choose factors that over a long period have outperformed the stock market. Usually, it is done through ETFs. The ETF will follow an index that selects stocks by one or multiple factors. The purpose of factor investing is to get better returns than the market and also add diversification to your portfolio. Hi, welcome to The Holder Investor, and in this video, we will dive into factor investing and how it can help you to get better returns. If you want to receive more videos about investing, consider subscribing and turning the notifications on. The efficient market hypothesis states that share prices reflect all information available. Consequentially, make it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. For investors to generate a higher return than the market, they should take more risk. A higher return with the same risk is known as alpha. The Eugene Fama and Kenneth French paper, A 5-Factor Asset Pricing Model, shows 5 factors that explain 93% of the performance difference between diversified portfolios. Exposure to these factors leads to a higher expected return during long periods of time. These 5 factors are market beta, that indicates the volatility of the company; size, small caps tend to perform better than large caps; relative price, also known as value stocks tend to perform better than growth stocks; profitability, profitable stocks tend to perform better than stocks with weaker profitability; investment, companies with conservative assets growth tend to perform better than companies with aggressive asset growth. Let's look at some historical data to check the annual return of these factors. In the US from 1963 to 2020, small stocks beat big stocks by 2.04%. Value stock beat growth stock by 2.68%. More profitable stocks beat less profitable stocks by 2.80%. And stocks with conservative assets growth beat those with aggressive asset growth by 2.93%. In developed and emerging markets, these factors also have similarly significant returns. You can use combinations of factors to get higher returns. The 2 factors that have the best returns combined are small caps and value stocks. There are some ETFs that follow the S&P Small Cap 600 Value Index, for example, IJS, VIOV, and SLYV. If we compare IJS with IVV that follows the S&P 500 index, we can see that from 2000 to 2021, small caps value returned 783% against 394% of the S&P 500. This shows us that factor investing can be a good strategy to achieve higher returns over the long term. However, these returns only work when you have hundreds of stocks, like in an ETF, for example. You cannot get those factors returns by choosing individual stocks. The stocks that had the best return individually were small caps growth stocks. However, on average, small caps values perform better than small caps growth. That means that for stock picking, you should not try to use these factors to choose which individual stock to own. Investing only in these factors may sound attractive because of its high returns over time. However, as we see before in the efficient market hypothesis, this high expected return comes with more risk. So that is why you should diversify your portfolio. Factor investing is not limited to these 5 factors. There are a lot of investors and academics trying to find new factors that can generate higher returns. One example is the momentum factor, which states that stocks that have performed well in the past would continue to perform well. On the other hand, stocks that have performed poorly in the past would continue to perform badly. Although the momentum factor has a high expected return, it is hard to implement in practice as there is a huge problem with turnover and transaction costs. Some ETFs use this factor as well, for example, the MTUM. To sum up, factor investing is a good strategy that can increase your expected return by adding more risk to your portfolio. You can invest in factors that have been proven over time through ETFs. Let me know your opinion about factor investing. Leave a comment here about what do you think of this strategy. I think that using factors in your investment can be a common sense thing to do. In the Little Book of Common Sense Investing, John Bogle, the founder of the Vanguard Group, shows us that successful investing is all about common sense. He believes that investing through index funds is the best option. You can check out the summary of this book in the description below or in the card that is right here on the screen. Please click on the like button and subscribe to receive the next videos. This will help me a lot. Thank you for your time. Bye.